imagine that if it was you that was doing this trade, of course, you would be buying as soon as the RGL went bullish, right? That's the point about the RGL trade in the first place. We've talked about this before. The point about the RGL trade is that they can hedge out their exposures by buying and selling in the futures markets. So obviously, when the price goes north above this RGL here at 392s, of course, they're already long. So they're not long stocks, of course, but they are long the futures, and they can hedge out their exposure to the upside by doing that trade. So if you were in that position, if you were selling this straddle, then you don't deal with the fact that there's an enormous gap here. You simply deal with the fact that you're already long the futures markets against your straddle, so that when the price breaks north out of here, you're not going to lose any money. That's where, if you ever became like a full-time 100% professional and you wanted an income source, this is obviously one of the key income generators for professional retail traders, if you like, people who have access to selling option straddles. If you've got access to selling option straddles, it sounds like a very risky scenario indeed, but actually it's not, because you've got access also to the futures markets to proactively hedge out those exposures literally from the minute you sell the straddle, right? So imagine, for example, you sell a straddle anywhere. As soon as you sell that straddle, you get $1 premium, and you buy or sell if the price goes up or down. Now, of course, if it chops through those areas, you can eat away at those premiums by taking small stops, 10, 15, 20 times. But obviously, if you have an idea about being able to get in and out of these trades in terms of the hedging, the delta hedging, basically the delta hedging in this one rather than specifically gamma hedging, then of course you've got to be available 24 hours a day. Now that's where the challenge is. That's where the challenge is, Miguel. You've got to, because obviously for time decay to work in your favor, you've got to be available to take that time decay onto your books. But you can do this at the cash open, remember. Now, because you're doing it at the cash open, of course, you've already lost the overnight session. Yeah, you've already lost the overnight session. So you've lost an awful lot of the time decay at that stage, and you're giving away an awful lot of your profits because you're obviously not able to hedge in the overnight session. But obviously, if you've got an alert that brings you to the screens, a lot of people's not going to want to do that. But obviously, if you were working with somebody, if you thought to yourself, I'm going to start working with somebody else that's in a different time zone that trades the overnight session, they can hedge my positions. Obviously, you've got to look at the ability for somebody else to log into your trading account and allow you to do that. That's obviously a big ask. But if you've got somebody that you obviously know very well, somebody that you rely on, somebody that you're confident about, then that can be something that can obviously happen in terms of different time frames. Well, it's not naked, is it? In a lot of respects, but it's not naked. Because obviously, if you're hedging, it's not naked, is it? I mean, you're hedged. I mean, it's just a hedge trade. I mean, I wouldn't suggest for 1 second that anybody does what the market makers do here. Sells that option at the close, and that's it. They do nothing else. But that's what a lot of dealers do that. I mean, that's exactly what the dealers do. They sell into that closing bell, the big volumes, and that's where they get the pricing from. That's where we get the pricing from. Is we sell into the closing bell, bag some monies, because look how much money you've make on this trade here. It's basically 394.70 versus 390. It's $4.70 per share. You're getting $4.70 on a $400 product, which is over 1% for a day, isn't it? It's 1% for a day. You had $6 the previous day. You've got $4.70 today. That's $10.70 in 2 days. And so long as you obviously hedge this line each day, you can see that you don't lose any money. In fact, if you're good at hedging and you're good at gamma scalping, obviously, and you sold, for example, there and you bought there, you could have cleared up massively there. assuming, of course, you had to then hedged out that exposure as it broke back south out of that area. Now, looking at the pricing of the markets here, I was really quite enthusiastic about that phase. I was less enthusiastic about that phase into the highs. I was really enthusiastic. I was enthusiastic enough about this phase. On a macro chart basis, you can agree with me that the price of volatilities seems on the face of it to be, pretty good down at these low edges. And into the closing bell, I don't think they'd wiped out that narrative, had they? I mean, look at the price of volatilities in here. Look, closing bell. So into the closing bell, you can see that there was definitely a feeling that this was going to be a bullish market tomorrow. And that's why we've got 33 over 25 at the moment, 33 over 25. It was very similar to this type of day here. And it was very similar to this close here. I mean, when you look at the price of volatilities here, I mean, is there any... I mean, I think that 21 over 22 based on the pricing is wrong. I mean, if you saw the pricing here, if you saw that pricing, most of you would probably look at that and say, well, I'd probably price this at, 25.18. Would you agree with that based on the volatility of volatilities? You'd probably say 25 over 18, so you'd bring that box up a little bit, and that would have obviously allowed you that bit of a higher price range to hedge into based on how the pricing of volatility. So I was a little bit surprised in some respects. 21 over 22 is not as bullish as I thought it would be that day. 34 over 34 was obviously accurate for the most part until Yellen pipes in, right? Almost perfectly accurate until Yellen pipes in, and that drove the hedge. So you can see the importance of making sure that hedge is in place, because if you missed that drive, you've just got a big painful loss, haven't you? Because think about it, how much money did you take in terms of your premium? Well, remember, it's very easy to do this calculation, guys. It's that high price against that price. That's how much your income was that day, right? So you just bring that income down. How much did you make? How much did you lose? Well, all your calls remain in profit, don't they? So your calls all end up in profit there. So that income is still visible. That income is still available. But obviously, if you started to lose on your puts from here onwards, you lost that amount of money there, didn't you, on your puts? So obviously, when you look at that narrative there, you're losing money if you did not hedge. Simple, isn't it? Simple. You lose money if you did not hedge. That's true of any box like we draw in these charts. It's true of any box. But when I'm looking at this morning's business, if we look at last night's close, you can see that last night's close seemed on the face of it to be really quite negative. But on that grand scheme of things, you can see, whilst it's negative, is it that negative? Well, sure, it's negative, but it's not that negative, is it? So when we look at last night's close, we can see that the price should not be below this level, should it, technically? We should probably be okay in this level here based on how the price of volatility is developing. So based on the closing price here, I think 33 over 25 looks about right. Based on the early pricing, it looks like we're getting a big drop-off in volatilities. And with that big drop-off in volatilities, to me, it seems very reasonable that the buyers are likely to come back in off of this top line and hedge aggressively into these areas here. Looks like that's a very obvious level 2 buying opportunity for anybody that was watching the volatility of volatilities. The volatility of volatilities obviously is a very sensitive indicator. It's not the price of volatility, but the volatility of volatility itself. If volatility of volatility is increasing, then that's obviously a possible early warning signal to something quite bad, quite dangerous happening in the marketplace. If volatility of volatility is, however, dropping, it's quite a visual signal. So with volatility of volatility dropping, to me that looks very good for a buy trade at bottom edges. And it was very good for buy trade at bottom edges. Kind of sensible? Sure. Make sense to everybody? Absolutely.